So guys, I'm back for another video, and today I'm going to be talking about Alibaba. It's been a while since I made a video on this stock. There's been a few earnings releases, partly because I've just been working at a new job, but I've started to get settled into the swing of things at this new job, and I'm starting to find that I have a bit more free time to start making YouTube videos again, which I'm really excited about. Because I've been starting this new job, I haven't been looking that much as I usually do at my investments, but there's a bit of a lesson here, I think, because a lot of people are just too trigger-fingered, I think that's the term, with their investments. They're constantly looking at them and constantly changing them. Really, what you want to be able to do is focus on life. That's the whole point of investing, is that your money is working for you. You want to do the bulk of your research before you buy a stock, and then after that point, you just want to be checking up on it. And because I did a lot of research before purchasing this stock, I didn't feel the need to constantly act based on every piece of new information that got released. And also, when I came back to it now, I was able to leave it a few months because I know that I had no debt, so I wasn't worried about that. And I had a good understanding of the macroeconomics, Chinese-US trade war situation, so I wasn't too concerned about that. And so what I was able to do was come back to this investment and look at it with fresh eyes. This is probably extra worth doing right now because since I last made a video on it, the stock has skyrocketed 80%, which will be quite interesting to see how the comment section changes on this video, because the last time I made a video when Alibaba was potentially at the greatest value it will have ever been at. I mean, people will be talking about buying it at $70 forever from now on. But basically, on my last video, when it was at like $70, $80, people were talking about Alibaba being a scam. And that wasn't really the case. What was happening was, because the share price had fallen, more and more people were getting rid of their shares. And then as a result, that was causing the share price to fall even more. But the company themselves were actually buying the US shares. But I don't want to get too heavy into the nitty-gritty on this video. What I want to be talking about is, just like I was, going back to the basics, looking at this company as if it was day one of my investment. So first, let's get back into a bit about this company. Alibaba's beginnings, the basic fundamentals of their business, is a lot like Amazon. They are an online retailer and they have huge warehouses and amazing infrastructure network across the entirety of Asia. Their long-term goal is to be able to deliver any product anywhere in the world in 72 hours, which is incredible, incredibly admirable, even more incredible because they might actually achieve it. As for the Trump tariffs, that's the other element that's got to be mixed into all of this. I looked at that again with fresh eyes. The fact is, when you're looking at Alibaba specifically, most of their revenue comes from selling Chinese products to Chinese citizens. And as Trump increases the tariffs more and more in China, I think what we're going to see is that the tariffs have relatively little effect on the earnings of the company. The reason the earnings are suppressed, and this is the next thing that we need to go into, is because of COVID. We had an extremely tough regulatory environment during COVID from the CCP, and China and Asia cracked down a hell of a lot more than we did in the West in order to deal with COVID. So finally, to sum up the business, you have the Chinese version of Amazon.com that literally can't have any competition from Amazon.com because the CCP bar it, so it's got an enormous moat. Then you have smaller high margin businesses like the Amazon version of Amazon Web Services, the Alibaba version of that. Then you have things that Amazon can't even do, like Alipay. So you have their own banking business. Then you have a bunch of other high margin things, autonomous driving vehicles, infrastructure like that. Then you have, on top of that, you have Alibaba's version of ChatGPT available in China. So that is just the icing on the cake on this one. So looking at the business's core, I think that we are still in an incredibly exciting time. Now we just need to get into the numbers. The market capitalization of Alibaba is 2.3 trillion and the earnings are 20 billion. So this means the price to earnings of the business is 20. So if I spent £20 buying shares in Alibaba, I'd earn £1 a year. However, Alibaba are a bit unique compared to a lot of US stocks. They have 500 billion in Chinese yen. Sorry if I've been saying pounds or dollars up to this point. Everything regarding Alibaba shares is in Chinese yen. 500 billion Chinese yen. They have that just in cash that they are using to buy back shares and pay dividends. So to provide context, if you bought a house for £2 million, this is like finding £500,000 in cash in the floorboards of that house. In the exact case of Alibaba, it's a bit like paying 2.3 trillion doesn't really make sense because you're going to get 500 billion in cash. So it's a bit like paying 1.8 trillion for the company. You would also want to factor in debt in this, but there is so little debt in this company that I'm not really going to count it for this formula, but by all means, you go ahead and do that. Once you've factored this in, the price to earnings, the TEV technically to earnings comes down to 15. So for £15, you could buy $1 a year. But here we go again. So if you went back to the highest earning point, 2017, then the price to earnings today would be 10. So we haven't gotten back to that point yet. So what we're going to experience, I think, some point in the next 2 years is not only getting back to 2017 levels, but far exceeding it. Of course, that might not happen, but I think the basis from how I understand the company, the core of what the business is, I think we'll get there easily. The fact is, there's not going to be an incredible competitor coming out of the woodwork anytime soon in order to force Alibaba to lower prices. They'll be able to keep the prices where they are because the competition would have to spend billions in order to be able to have the similar infrastructure to Alibaba. Now, this is why from this point, I don't care too much about revenue growth. I'd actually like them to slow down a little bit on their spending, focus on their core business and see how profitable this business can be. What are the margins really like? But I don't know if they'll do that. They certainly seem keen on continuously reinvesting in the business, but I would quite like to see if we could go back to 2017 level margins. Especially seeing Chinese consumers going back to work en masse and their savings recovering and all of these other things, their spending will be increasing. I definitely think that now is the time to see margins grow. Regardless, you have a tech firm here in China that isn't just the budget version of US tech stocks like Amazon. It's in lots of ways exceeding them. They are in the country that is building the infrastructure for these companies, which has a very real, tangible price to earnings of 20 today and an adjusted price to earnings of 10, where the US tech stocks have price to earnings of 30 and upwards. Tesla has a price to earnings of somewhere in the hundreds, which is absolutely ridiculous when you think about it. But these companies have adjusted price to earnings that actually go down because they far overpaid their employees. They're using stock-based compensation, and because they're using stock-based compensation, a price to free cash flow that might look like 30 could well actually be something like 50. Now, if we go back to 2017, 2020 levels of earnings, pre-pandemic earnings, then we are going to see a return on the share price. The price to earnings of this stock, I think, could quite easily go to a price to earnings of 30. And if that happens, then we will see a tripling of the share price because we'll see increased earnings and then an increased ratio. Now, the crazy thing about this is we've already doubled from where we are. As I said, we are 80% up from where we were about a year ago. What makes me really mad is just how many people slept on this stock. Like, it's just a classic case of the truly valuable positions when they are at rock bottom dirt cheap prices, the increased rhetoric, the negativity floating around the stock in total abjection and tangent to the facts, the business, the thing that you can see. What happens is people start believing that there must be some issue there that they cannot see and cannot touch. And so in this situation, people just blamed the CCP, just blamed China, when in reality, it was just the same thing that is always affecting stocks, which is fear and greed. In the US, we have plenty of greed, and in China, we have plenty of fear, but we also have plenty of incredible companies. And so it's a wild thing that people are so apprehensive towards investing in something that is so innovative. But I guess that is the benefit for me. That's why I made this video. It's why I'm still comfortable in this position, even though it's practically doubled in price from where it was a year ago. And I'm really excited to see where it goes into the future. I may never sell this stock because people may never truly stop undervaluing China. So yeah, that's why I'm excited about it. That is my conclusion from getting back into it and doing some research on it. The thing that you really need to do if you want to be rich is